we're going to try and now apply what we were speaking about at a higher level to a more practical level, and show you some of the potential quick wins that are out there. Can I hand it to both of you?
Good morning again. Thank you for being here. I think we've talked about who we are a lot in terms of this is TransUnion, what are we capable of, and this is where we're going. So now we want to show you a bit of what we've been talking about, just to check the rest of your pulses, you know, in terms of how do you perceive us? Who are we to you? I'm going to ask you 3 key things, or we're going to talk about 3 key things to see where your perception is in regards to us. And the first one we're going to talk about is conversations. So what conversations are you having in your corridors? Is it about, give me a credit report attached to the application form? Or is it about, are they listed, not listed? Or have these conversations actually grown a bit richer? Is it about now, are you offering the right product to the right customer at the right time? Are you offering, or are you actually optimizing your, and here we're talking about conversations now, are you asking questions like, have we optimized our processes? Have we optimized the kind of data we collect to actually ensure we're booking the most profitable segment? And actually, out of this profitable segment, what is the size of it? You know, are these the questions we're asking, or are we still going back to, are they listed, not listed? So that's the first point. So on these 3 lists, if any of you, you don't actually have to tell me out front, but if you're thinking, no, we don't do that, no, we don't do that, no, we don't do that, in any of the 3 items, we need to have a lot more engagement, a lot more conversations in what we can do. The second one is people. So whenever we go into our client spaces, there's always 2 sets of business functions that are always highlighted. It's always risk, or majority of it is credit. Those are the 2 main business functions that know about what we actually do. And even then, it's a growing steep knowledge. The other people, we are the marketing people. Can we help you target the right customers? We are the strategy people. Once we say we want to grow credit cards from 1 billion to 2 billion, where is that data backing it up on where the gaps are? Where are the, I don't know who else, collections people, where are the products people? Are you designing the correct or the relevant products for your people? So when I talk about people, how many in this room can actually say we're all inclusive? Everybody is actually invited to the party. How many is including, how many people are including marketing, strategy, collections, product design, or is it just working in silos in terms of credit and risk? So if that's a no, we need to have more conversations. The last one is data-driven. The reason why I have data-driven on there, I keep blocking it. The reason why I have data-driven on there is because a lot of us want to get into a situation where we're having smarter conversations, and we all know that they all say to have smarter conversations, you need to be asking the right questions, isn't it? But what are the right questions in terms of you and us? The right questions have got to be data-driven questions. So I'll give you an example. Say, for example, you go to, at the end of this year, I think we, not all of us, but most of you go for strategy sessions outside your offices. So you go to Naivasha and you decide, what are we doing for 2019, etc. Whenever you go for those strategy sessions and you're sitting around the table, what are the kind of questions you're asking yourselves? Or are you just setting targets when really there's a segment of data you're missing? So I'll give you an example. Say, for example, Ali Khan comes along and he's part of your client's base. So you're saying Ali Khan has a credit card and a mortgage, but I want to book more revenue from him because I want to grow my business. What if then we asked you, based on what? What does Ali Khan have? What's his gap for me? So I'll come and tell you, according to the data, Ali Khan is very profitable, not only with you, but across the industry. He's actually shopping around for something. Ali Khan, you're offering him a lower limit than the market is actually offering him. These are the questions that should be asked in your strategy sessions. You know, they have to be data-driven. Again, I ask you, how many of you are doing that? And not only actually in the strategy sessions in Naivasha, but also in your board meetings, your strategy sessions, down to your sales daily meetings. Because how many of you, again, are empowering your salespeople with data showing, out of this 1,000 people that I want you to actually contact, I can show you who is currently shopping for whatever product. Go out today and reprioritize on who you're going to contact first. How many people are actually sending off their salespeople that kind of data? I don't think that's happening. So if you actually answered no to at least one of these questions or one of these scenarios, we need to actually be engaging a lot more. Agreed? So now bringing it back to what we were discussing about what we do, we're going to show you just tangibly on some of the insights that our information is showing. We're going to start on a high level from the market view. So on here, you'll see we started with 2015, right? The reason we actually started with 2015 is because prior to this, we were only receiving negative information. We weren't getting any positive information, but come 2015, we started receiving both positive and negative. And it's crazy how many bankers actually don't realize that, you know? So we're getting positive information on there, and then it starts growing up. Oh, sorry. And then it starts, the trend starts going up. The black line on here is, I think, the overall industry. So in terms of accounts, they're booking more accounts progressively. The yellow line is, I think, is it microfinance? Microfinance. And the blue lines is you guys, the banking sector. So it's also growing in terms of accounts. Oops. In terms of accounts, but also in terms of outstanding balances. So can somebody actually guess what happened here in 2016 when it almost doubled? Why were we having more accounts being booked, but then the balances were relatively the same? So it came on, sorry? Absolutely, yeah. The mobile lenders came into play. So we got a lot more information in the database in the bureau. So we went from almost 4 million to 8.5 million accounts. In terms of value, it was around 810 or 814 billion. But on here, the banking sector is actually leading in both. When we look at the NPL rates, again, this is to be expected as to what you're reporting to CBK. So we have on here less than 10% on the NPL ratios. The yellow line on here is the microfinance. The reason that is there is because of the number of accounts they have relative to the rest of the sector. On here, this line here is the fintechs. The reason it actually shoots up that quickly or that high and then comes down is because when they first came into the market, they were submitting information that was negative. So if we're talking about NPL, it was all negative, and then now they've started submitting both full file, like what the sector has been doing all along. On here, so remember we've talked about accounts increasing, we've talked about the balances also going up, the NPL ratios as to be expected. Now we'll look at the risk distribution. On this risk distribution, I think there's somebody who mentioned, what are the profitable clients in the market? And do you have a view of that? Because when you look at this, graph, it's not pointing anymore, this graph, risk profiles actually run from AA to JJ, yeah? So AA, BB, CC, DD, up to JJ. AA to somewhere about GG is the low risk segments according to our generic score, and the rest are high risk. So when you ask yourself, out of the population that is actually borrowing, and those 8.5, the 8.5 accounts I mentioned before are spread across about 6 million borrowers. It's because we're obviously multi-banked. But out of that 6 million, and the rest who are going to be increasing, what does the industry show in terms of their risk? What we've seen from our data is about 41% across the industry are the profitable segment. So we're talking about AA to GG here. Those are the profitable segments. These are the guys that you should actually be tapping into. More importantly, what is your segment? Out of the 41% profitable segment of the population, what are you carrying in your wallets? Is it 5%? Is it 2%? Can we increase it? Can we help you support growing it? You see where I'm coming from? These are the questions we should be asking ourselves when we talk about insights. The other thing, conversely, is if 41% is the low risk, the other percentage, which is what, 49%? 49% is a high risk. Again, you ask yourself, 49%, how do I sit? Am I carrying the majority, which would be a bit crazy? Can we help you bring it a little bit down? And so forth. Now, going down to the banking, so we started with the industry. If we go down now to the banking sector, in terms of products, this is the products. We can see there's been a growing trend in the mobile lending space. And that's the most significant. Okay, that's the most significant. And then followed by the yellow line, which is personal loans. And then there's a bit of credit card right at the bottom, which is the blue. And I think business loans. That's what the industry is doing in terms of lending. Mobile loans on an increasing trend in terms of booking them, but the rest are relatively more or less the same. They haven't changed that significantly. Again, remember on the previous slide, on this one, this was industry view. We said 41% is the profitable segment. When we drill down to your sector, banking sector, it's actually 43%. What does that mean? You still have about 2% more to play around with and to book more profitable business. Again, I ask you, out of the 2%, who's going to be quick enough to actually book it? Because the insights are there, the data is there. What are you going to do about it? We did a sort of focus group, and we were talking about credit cards. And what came out from the people we were asking is, I can do it right now. I can do it anytime. I don't have to fill in any form, you know. So they felt a lot more in control with a mobile loan than a credit card, because they also said with a mobile loan, I'll repay it next month. With a credit card, I'm going to max it out and be debt for, what, a year? Yeah, so it gives them a lot more control. That's what came out of the data that the research that we actually did. We started from the market view. We drilled down to banking. We're going to drill down to now the tiers. Okay, so drilling down to tier 1, this is just an example. So everybody else on tier 2, 3, and 4, this is information that's available to you as well, but we just took tier 1 as an example. If we look at the balances, we have, on the blue line, we have the tier 1s, and they actually show, they indicate that they have the lowest volume in terms of, the lowest value in terms of ticket sizes, which is also collaborated on the NPL side as well. And then, and the reason for this is because we have a lot of low ticket items in terms of mobile lending, and they play a lot in that space. On the right-hand graph, we have the NPL ratios. Again, tier 1 is sort of doing really well in maintaining it below 10%. The rest, tier 2, 3, and 4 have increased slightly, but that could be attributed to them booking less accounts vis-a-vis tier 1. And now just to have a snapshot on what the insights show us without the mobile, because not all of us are mobile, but we would like to see what does it actually look like. So again, let's take the example of tier 1s. We've looked at the accounts, and we've also looked at the average balances. On the accounts, we see that there are two, okay, we looked at, in terms of tier 1, we looked at 9 banks in the tier 1. So out of this, we can see this color here, orange or dark orange, and then yellow. There are 2 major key players in terms of the people who are booking the most business in terms of accounts, yeah? So they have the most here. However, what does that story translate to when you go into volume, or rather value? The 2 people who are actually the key players on here have some of the lowest limits across board. You'll see on top over here, which is this Bank J, right at the top, very little accounts in terms of booking. Look at where the limits are. So if we're actually looking at a customer first era, if you were playing in this section here and you're saying, yeah, it's good business for us because a lot more volumes and a lot more guys are coming in. If I was part of your customer base and that's your strategy and I wanted a higher limit, would I stick with you or would I go elsewhere? Because clearly your strategy is not aligned to my customer first era need. You see what I mean? So that's that. And then the NPLs again on the tier 1. Just like before, the NPLs are all tracking around the 10% mark or below. Sorry, this clicker is just the first time ever. Yeah, so tracking below the 10%. With this one little bank here actually going crazy, but that's not anything alarming. It's just because they have fewer accounts, right, relative to the rest of the people. In terms of balances, again, we have the same, especially with this bank here, but who can guess which bank this is anyway? Can you all differentiate yourselves from this? You can? Okay. So whoever this is, the one in yellow, we can have a sidebar chart. And then on the balances, in terms of balances, again, the yellow guy is still there. And then this guy here was playing a lot with his strategies on NPL. What do I do? Do I try this? Do I try the other? So we started working together. And you can see over time, actually came to us in late 2016. We started working with him in terms of optimizing his collection strategies and his pre-delinquency strategies. And you can see now it's almost coming down, and it's almost coming to the rest of the level that we are at.
If you look at the NPL chart or the graphs, these are quite scary. I mean, if the industry as a whole is making 4% or less, actually in competition you're even making less. And overall, it seems like most of the banks are at 4% or 5% there, in terms of the balance.
Yes.
Now, how TransUnion can help the banks to transform in this regime?
So here it comes back to how are you managing your processes for pre-delinquency but also collections? Whenever we have these questions with the banks, they normally say pre-delinquency will print out a form, it will show maybe Daktari is 1 day in arrears, 2 days in arrears, we'll keep him aside until we contact the person who's 30 days in arrears. Is that really optimized? What we're saying is Daktari is 1 day in arrears with you, but he's 67 days in arrears with 3 other banks. So we help you prioritize. That's on the collection side, but the conversation should not wait until you've been hit by the punch. It should actually start from pre-delinquency. As soon as you start showing all these stress signs, we come in, we show you more insights, and we help you maybe, enhance your collection strategy or pre-delinquency strategies. That's the one thing, giving you the empowerment to do that. The other thing is, we worked with a certain bank. It's one of the, actually the yellow one as well, but they're very big in the mobile space. And we worked with them in terms of their collections portfolio. Their biggest thing was that it was increasing, but yet the people were not, the borrowers, even though they had non-traditional products like mortgages and asset finance, they were just not paying or servicing the mobile loans. So we went in, again, we prioritized, we worked with them on the conversation, but we also went one step further. Remember when we talked about Nipashe, the consumer empowerment tool? What we did was we started educating the borrowers in terms of why do you need to pay this, and communicating with them that actually your information might be detrimental to your future financial, maybe CV or something like that, and we actually saw a lot of movement. So there are various things that we can actually do to help you bring this down even further. All this, especially where you're seeing 20% in the yellow, this is data submitted to us, right? You might find that that is actually different from their angle because the accounts, the yellow line there is, it's higher because of the fewer accounts they have. So when we did the division, yeah, same thing, right? Or
yes. But this is more based
from
on
the
what has been submitted
to the bureau.
Yeah,
Absolutely, yeah. They might have something else that they're reporting elsewhere. So on here now, remember we came from the market view. Yeah. Between what is reported and what is actually with us.
Yes. So yeah, I was just making the point of what Sheila was making. It's important we try and explain that variance between what you do or what you get with your statistics and what the banks themselves report as values for their NPL.
Absolutely.
So if there's a gap, then
Yeah, I mean, it's a very good comment, and this is part of our ongoing challenging discussions with the bankers, with the lenders. Number one, yes, sorry.
The only difference could be because of restructuring. When you structure a loan, arrears disappear. But from CBK perspective, it may be NPL. But from the data perspective, it is not. It has no past due days.
So that's one way of looking at it. From our end, we still want you to submit all the data. Because yes, we have identified that sometimes you will submit, sometimes you'll fall off, you won't submit for 3 months, and that has a huge impact on what we're seeing. What we would say or maybe advise is, remember when we talked about a grudge purchase, the Bureau being a grudge purchase? Even internally, when you're actually working on your environment, how many of you have a dedicated space for this kind of thing, for TransUnion? Or is it relegated to an IT guy to submit the data as part, not part of his JD, but in such circumstances, what will happen is it's going to be done haphazardly. Nobody's really going to care. And that drives back to the data depth, accuracy, and compliance. So I'm going to allow Kevin now to drill further down into the products. Remember, we started from the market view industry, 41% profitability view. We went into banking, we went into tier ones, and now we're going to go into products.
Well, if I could add a comment around the data bit before Kevin kicks in. The last, Jared, probably 3 months, the technical working group, around about 3 months. I don't know if a lot of you know Jared Gatenga from CIS, so he's been working a lot with us on that. In the last 3 months, there's been an initiative driven by Central Bank, World Bank, CIS and the bureaus and KBA, and it was really around, let's look at where the gaps are, around the quality of data, the submission process, make it rather efficient and also painful, not painful at all to all the banks. But the interesting bit around that whole exercise was that as we went deeper and deeper into it in terms of, what kind of data are we getting from the banking institutions and what output is coming out of it, as we've closed the loops on a lot of these things, we're finding that the data quality is getting much better. We definitely are looking at the scores because I think one key challenge also has been that the banks have not consumed the scores so much. It's been around checking whether a customer is good or bad from a listing perspective. But then as we engage more and more with the banks through this process, we're seeing that one of the key pain points was that there's some confidence lacking around the scores, but that's also been addressed. I think the final report is going to come out to the banks in a couple of weeks' time, but it really has given a lot of confidence that this data that you're going to be consuming, one, of course, it's better in terms of, way better in terms of what comes in. But at the end of the day, it's garbage in, garbage out, So I must say there's been a massive improvement in terms of just that whole ecosystem. So you can definitely rely on the data as they come through.
One request to TransUnion, once you get the data, and if you see anomalies in the data, you can figure out, right, in terms of reporting. Please follow up with the banks, whoever it is, so that it will overall help all of us to get the right data and right information.
Thank you, Billy and Javed. So I'll try as much as dive into now all the products that we have. And if you have had a view of the data template that we usually use for the data submission, we have around 12 products. And so what we've done is we've tried to maintain the top 4 products that we've seen across the data that we usually receive. So we've tried as much as possible to maintain to credit cards, personal loans, and mortgages and mobile loans. Then for the other products, basically once we're done with this, we can be able now to share the decks with all the analytics that we had. So I'll try as much to cover everything that we have. So we've tried now diving into credit cards. And as you can see now, credit cards market has grown over time, slightly reduction in the first quarter in 2017. And I think that so what you try to do as much as possible is now try grouping everything per now the institutions, and we can see the average balances per now the volume of the number of accounts. And I think you can be able to tell probably where you guys are, because we tried now maintaining on the first tier banks, showing now the averages of now credit cards being at around 128,000. And yeah, so on the left-hand side, we can be able now to see now the graph now showing the number of accounts and now the balances now per each and every institution. So these are now, this is stock basically. This is not new bookings. This is now what we've been seeing since now the data was submitted. So for the first, since 2015, after now the reporting of the positive data to the first quarter of 2018.
I think I'm just going to add something on, chime in on what you're saying. So like Kevin said, the blue line on the left-hand side graph, we all know, you probably all know who is the leader in credit cards in the market. Again, the trend has been the same. We haven't seen them booking a lot more accounts, especially since the mobile lenders actually came into the market. However, when you look at those accounts that they're actually booking, can you compare it to the limit they're actually giving? So the questions should be to yourselves and to how your strategies are, even if you're going to go credit card route. This blue here, this is leading, but the limit is here. So if I was one of your clients and I was in the blue bank, yes, I would have your credit card. But if somebody else is giving me a higher limit, I'd probably utilizing a lot more. So those are the kind of insights we can help you with. We can show you which of your clients actually have the credit card, where is it being utilized more, what are the limits, you know?
So am I correct in saying that the analysis you're saying is that the biggest credit card provider is not actually maximizing the opportunity?
Absolutely, yes.
Yeah, and especially when you look at the bookings from now, I think this is Bank B. Sorry. So Bank B, we can see very small bookings, and especially now coming in at around the second quarter of 2017. But when you look at the balances, they have quite high balances. So once we move now to the next slide, where we now want to see the NPLs for the credit cards. I hope I'm not blocking anyone. So this is now how the NPL is looking like, again, per institution. And as we saw now from the first institution, Bank A, where they're having a lot of credit cards. When you look at the NPL per now, the number of accounts, then again, they're playing around an average of around probably maybe 12, 10% on NPL. But when you look again on the balances, we can see them again playing very low at around probably roughly around less than 4%, less than 5%. But again, the erratic move of that's Bank J. That Bank J could be now again probably due to reporting of the data. But again, yeah, so we can now see that erratic move. So I'll move now to personal loans. So we can see again now the personal loans. Generally, what we can see over a period of time, the average balances have been growing over a period of time. So the market averages being at around 280K. And again, we've shown now per institution. So I believe we can be able now to tell which institutions these are booking a lot of personal loans. But again, we can be able now to check again on the limits. So having very low limits from Bank J, or very small number of accounts from Bank J, but when you look at the average balances, again, they're having very high average balances. So towards whatever Wangeshi was saying, probably maybe the strategy which they're applying. So if I'm a client and I'd want to probably maybe have higher limits, probably I'll not be looking at the number of accounts, but probably look at where I can be able now to enjoy better limits. I think you can also see Bank A, where they're booking quite some number of accounts, which was, I believe, stabilized at around the first quarter of 2017 towards 2018. They're also giving quite significant average balances. So, yeah, as in, basically, the loans which you can be able to see now, like having higher limits of around 600K. From now, Bank J, you can be able now to see averages of around $1 million. So again, based on the strategies that you want to apply on the personal loans.
Yeah, so the idea here is go back and ask yourselves, are you actually giving this customer what they desire, or are they having actually to complement it with a secondary loan from another institution because your limits are too low? That kind of conversation is what we want to encourage, especially in your meetings, strategy meetings, board meetings, wherever you are. These insights are telling you a story. What are you doing with the story?
Okay. So we are looking at now the NPLs per now the same institutions. So the number of NPLs have remained stable, while balances have slightly worsened. When you look at the two different graphs, so the graphs on the left shows now the NPL per the number of accounts. The one on the right shows now the NPL per the number of balances. So we can be able to see some erratic moves from institution B based again on the number of accounts that they have. So per our calculation, we're looking at again at the total number of loans submitted per now the number of loans which have gone bad. So moving on, we've moved now to mortgages, where we have seen a stable growth in number of volumes, slight positive sign in the market, with averages remained stable over time. And sorry. So again, we've seen mortgages again grow, which they've remained stable towards the first quarter of 2017 towards 2018. And again, we can look at the similar story where we can be able now to see some of the institutions which are booking quite a number of mortgages. Then the averages again are quite high. I think we can be able to see that similar story towards the same institution, which is, I think, that could be Bank J. Sorry about the colors from TransUnion, so they might be a bit, they are not quite friendly.
So what is the total size of the mortgage market now then?
So the total we are seeing around probably the number of accounts coming to around just above 25,000 number of accounts. And the averages what we are seeing is around 8 billion.
So the total number of accounts, people with mortgages, is just falling under between 25 and 30,000, so maybe 28, like he mentioned. But in terms of average balances, we're seeing a trend around 8 billion mark.
These are quite a big opportunity compared now to at the population, where we need now to do more again on the mortgages. And we can only see like 2 banks which are now dominating the mortgage industry. But again, a stable average balances remained in over time. Yeah. So we're looking at the NPLs again. So there's a slight growth in 2017, while so we're trying now to compare again now the balances per now the number of loans that we've had over a period of time. So there's some quite erratic moves again on some of the institutions, but again this is now based on volumes and the number of accounts that have gone bad. So again now we move now again to the mobile lending. So we decided just to stick to the 4 main products that we so probably could show some insights on. So so the dominance on mobile loans have been seen from one institution, which I guess we can all tell who they are. So the average balance is being between 500 shillings to around 10,000. And it's been growing for over a period of time. And since now, we can be able now to see since 2016, where they started now again also now submitting positive information, we can see quite a lot of growth on the mobile loans. And again, we can be able now to see the players who are in the mobile loan industry. And again, showing the average balances. So it's quite funny when you look at the graph because so the institution that has a lot of, again, the mobile loans, which is booking more of the mobile loans, has the comes around number 2 on the average balances that they're lending on. So when you look at other institutions which are booking quite small volumes, and the same customers tend to enjoy better balances of them. So it's quite interesting. So once we are able now to see, I think, I will get to that point where we can be able now to show like now again the number of NPLs. So the volumes again and the average balances, we're able now to see that this institution is, the strategy that they're applying is quite good because they're also booking less of the bad customers. So we move now to new businesses. So these are now the new bookings which come now month on month. And I'll let Wangeshi take us through now this point.
I think that is actually month on month booking the most accounts, although that was at the beginning of 2015 when it tapered out to 2017, 2018, and this could be caused by interest rate capping or whatever it is. They're still the majority, the leaders in terms of booking accounts, month on month, right? The rest, I think haven't, okay, the purple one. The purple one is, what color is that? This one here, Bank F. So Bank F are the ones who have been the most consistent in terms of booking accounts. When you look at averages, even though this bank here has been consistently, relatively the ones who are booking the most accounts, what does the story show in terms of new business per month? Is still playing around the lowest limits, the lowest value. Could be strategy again, but again, we're in the customer first era. Are we giving them all they desire, or are they having to go to maybe a bank that's yellow? Can you see yellow here? Month on month is not even over here, yellow, a little yellow just after the blue. Very few accounts month on month, but look at the limits. Yeah. In terms of credit cards, again, the story is the same. We saw, remember the blue bank? Maybe this is the same blue bank. It's still booking relatively higher number of accounts in the industry. That's the blue bank. I think I'll just give up on this now. And then we have the ones in red. What happened to the ones in red? Why did they stop lending month on month in terms of, this is Bank E. Why did they stop lending on the credit cards? Did they move to a more aggressive mobile lending scenario? Who knows? These are the kind of insights we should be asking ourselves. In terms of the credit cards, new business, again, in terms of value, the ones with the largest, relatively, in terms of credit cards, are still booking below the limit. They're the first ones from the bottom. So what's the strategy there? Could be the correct strategy you're using, but is it, depending on when you drill down what your clients actually want. On this graph, I don't know, okay, on this graph, we're actually going to show what is happening in new business on credit cards, but in terms of existing and new business, and what are the risk profiles. Remember when we said our credit score runs from AA to JJ? So on here, we can see new business that's being booked in the market. The bankers or the lending, the banking sector is booking a lot more low to medium size risk borrowers, whereas before they were actually all over the place. There were more high risk, okay, medium risk, and there were also high risk on there. In terms of personal loans, this is again new business. We have two banks there. Okay, we have 3 banks actually on there that are leading, but is the story the same in terms of value? So the same logic actually applies to what we saw previously. This is information you can actually take down, drill it down to the borrower themselves, the limits, whether they're shopping around, and then make your decisions. Personal loans, what's happening between existing and new business? Has the market changed? Before you saw that the credit cards, you guys are actually booking between BBCCDD, which is the medium to actually the medium segment in terms of risk, which is good for credit cards because you want those people who are actually maybe going into 1 or 2 days into arrears because you can charge them more. In terms of personal loans, it's a bit more restricted. So you'll see that in terms of new business, the blue one here, you're going more towards now the better risk clients as opposed to spreading it out like you were doing with the credit cards. And this talks to the power of the score as well. Mortgages, what is happening? Again, 2 main lenders still booking the same thing at the limits, showing the same story. So we'll see the red on here. Who's the most interesting on here? So we have this blue one here that were first, they were first quite aggressive, and then they went almost outside the radar in terms of accounts, but then their limits are increasing. So they changed strategy there. Is it the right strategy? Again, drill down to your client level. Same story with existing and new business. So in terms of the mobile analysis, I think Kevin can go through this, yeah?
So, so again, these are new bookings based on now the mobile loans, and they are dominated by one institution, basically looking at, again, now the average limits that they are offering. So again, it's a similar story where we can be able to see now the number of accounts that they are booking versus the average balances. So they tend to give a lot of loans, but the customers do not enjoy the best average balances. But again, we can be able now to see like the average balances in the market are between now 4,000 to 10,000 shillings. So what we did is, so at TransUnion we have 2 scores. We have the generic score and the mobile loan scorecard. So our score runs between AA to JJ, AA being now the low risk and the JJ being now the high risk. So we came up with a new mobile loan scorecard, which basically helps us to differentiate between now the people who are borrowing on mobile loans compared now to the traditional loans. So we can be able now to see between the 2 graphs, the graph on the left showing now the generic scorecard, which ranges between AA to JJ, and it ranges between now 0 to 1,000, AA being now the lowest risk, and JJ being now the highest risk. So we try to show now the same population of the new bookings versus now the existing book, and how the risk distribution is. And once we look at the graph on the left, we're able to see that there is, so the existing one was quite booking customers who tend to be high risk compared now to the mobile loan scorecard, where you can be able to see a differentiation on between now the customers who basically borrow now on mobile. So the best now product where now you want to lend on mobile being now the mobile loan scorecard, which now helps now show that differentiation between now the clients who are borrowing on the traditional loans compared now to the mobile loans. The kind of variables that we used. So one of the variables that we are looking at on the generic scorecard was the number of accounts that you open and close. And it turned out to a bit of, not penalized, but it turned to bring a score down. So the first scorecard was a rule-based scorecard. Then now we had to recalibrate in 2016. Now the coming in of the mobile loan score, the mobile loans, we decided now to come up with a new product where we saw that once you have so many accounts that are being opened and closed, then you tend to get penalized. So some of the variables were removed from now the older scorecard, and now we came up with a new scorecard which tend now to differentiate between the customers who are borrowing on mobile and customers who are borrowing on now on mobile.
So is the mobile scorecard purely based on mobile loans only?
No, so the mobile loan scorecard tends to show your probability of defaulting on a mobile loan, but it also puts into consideration all the facilities that you have. Yeah.
I think that, just to add on to what Kevin is saying, the main components between the two scores is the generic score in terms of observation. So if we're going to use the generic score, we're going to observe you over a longer period, 24 months. So we're going to predict your probability to default based on 24 months. And then on the other one, it's actually based on a very short-term period, 1 or 2 months. Is it 31 days? So your probability to default on the 31st day. So even the whole modeling has been different. The variables, yes or no, don't really differentiate that much, but the power of observance, the predictability and the period shows us a difference in terms of what is mobile and what is generic.
Maybe just, sorry, on the mobile scorecard, yeah. So eventually once the guy who's taking it pays it, once the guy pays, are you factoring that in terms of building it, synthesizing the data further? Because I'm still the same guy. And I know you guys talk about, my behavior will be different if I take mobile instead of paying my mortgage, for example. Yeah. So once you factor in, yes, so once you factor in maybe my 3, 4, 5 payments of different mobile loans, do you use that then to synthesize your mobile score? Because I'm actually still very unclear on the difference between the two, between generic and mobile.
We all understand that data is reported to themselves at a snapshot point in time, but the behavior on mobile is very different. I could take a facility in the morning and pay it in the evening. I could take a facility on a Monday and pay it on a Saturday. So do you have visibility of the borrowings and repayments intra-month, or do you just get sight of on the 10th on the snapshot position that is being reported?
So that's the ideal scenario. So during the panel discussion, you remember, I think it was Billy or Lee who mentioned that we developed the live submission API that will enable us to capture that information, whether you're taking a loan today at 3 a.m. and then paying it back at 7 p.m. And that will add on to what Wakaba is saying in terms of the richness. So then my challenge to you is, we have the live submission already working. Are you willing to test Timiza with us?
So what we've done is, so there are different variables that were used to come up with the different scorecards, and some of them, for example, we look into the number of inquiries done on the generic scorecard. So if we were to look at on the number of inquiries done again on mobile, then we're going to a bit of penalize some of the customers who are borrowing on mobile, because like Crispa said, the people who are borrowing and paying back on the same day. So you can imagine the number of inquiries that can be there. So what we did is we tried as much as possible to be able now to look at the data which was submitted to us during a certain period of time. And we're able now to look at the correlation between now the data that we had being submitted and what we could be able now to come up with. And now the mobile loan scorecard basically looking into your probability of defaulting on a mobile loan, but also taking into consideration your traditional loans that you have. So some of the variables are a bit different from now the two scorecards. But again, you can be able to either use the two scorecards based on whatever you want to lend on. So if you want to lend on mobile, then again, we would basically be able to recommend you use now the mobile scorecard, because it helps you now show that differentiation.
Okay, and if I could add, Vincent, I think one, so is it perfect? It could be better for a number of reasons. So while we synthesize the data and build it into the model, one thing we know is that it can only be as good as how well, it takes into account the frequency of, the repayment. Yeah. So the challenge that we've taken upon ourselves is really to socialize it further and ensure that the real-time submission takes off. That's number one. The more we get it real time, the better. But then I think the other key thing that that we are, and I talked about it, is what other additional in the mobile space, what other alternative data can I add as a layer? Yeah, because I'm only give you a view of somebody who's credit active today. There's still another huge data set who could still be borrowing on mobile that I'm leaving out here. So that's one thing that we still need to definitely add to develop the value of MLS.
My question is, on the mobile side, what's your definition of default? At what point? Because most of the mobile loans are really short. I mean, we cannot use the CBK definition.
So what we've looked into is default being on the 31st day. So on the first day after the 30th day, based on lending being 30 days on mobile. Yeah. So on the other generic scorecard, we are looking at you going bad on the 91st day.
Mm-hmm.
Yeah.
Thanks. I think there's some unanswered questions about the mobile scorecard, which you can take offline. But I think I just want to understand from a conceptual point of view, are you then talking of people having different scores for different products? So that I walk around as an A-rated home loan product customer, and then when it comes to mobile loans, I have a different score. Is that the way it's going in the future, or what are you thinking?
No, so
just to add to his point, even as you answer, to be very candid, they have two different pricing matrices for the two, and for us for people who have used the generic scorecard longer, I really don't see the value add, and so to say, move on to mobile yet. So maybe that's what he's asking. What exactly about mobile? I know it's not about what I think the value of that data in the near future and so on, but as of now, what would actually sell the mobile scorecard piece? Because as a banker, I would rather 24-month data of our customer for me sells more shorter period than the same thing.
So where are you going to get the 24 months historical data? No, on a mobile facility, considering, number one, there's the anomaly that Crispus has actually asked. You borrow at 3 a.m., you pay back at 7 p.m., there's a gap. There's the fact that you guys don't want to use the live submission to do that. You're never going to get consistently to right now, and that's what Billy was saying, it's forever changing. So when, just to add on to what Kevin was saying before in terms of the difference between the mobile scorecard and the generic, when we talk about variables, and one of the main variables in the generic score is this product secured or not? Yeah, it's very highly weighted. When you look at the data in terms of repayment, even on the raw data, if I take you Akaba and you have a mortgage asset finance and a mobile loan, you're probably servicing the mobile, the other non-traditional, non-mobile products, but not the mobile loan. So you will definitely have very different behaviors because they also have very different characteristics in the facility itself. They're short-term, they're not secured. Yes, it's due to be iterated, but I think it's still a good differentiation between taking a mobile facility and scoring somebody on the generic and also on the mobile loan scorecard. Yes, we've actually done an exercise to share a question in terms of how do you score on a mobile and how do you score on a generic, and they are different. So I think the best thing, or maybe one idea would be, let me take your M-Wallet population. Let's look at how it's scoring on the generic and on the mobile loan scorecard. Are there any differences? Are there any uplifts? Because if we keep talking about this and that without actually putting the data and seeing what it's showing, I think it will be a long conversation.
Okay, just to add to probably maybe your question, you're only going to have, yes, the two scores, because what you're doing is you're putting into consideration all the facilities that you have. So if you don't have a mobile loan, then you're still going to have a score because you're also looking into your traditional loans that you've borrowed. So basically you're going to have, yes, the two scores, regardless of you borrowing on mobile or not.
I think we grouped all the longer term tenure loans together, be it asset finance, be it mortgages, and came up with the generic score. What you're proposing is actually a step further. The population that's actually performing on mortgage, does it mean if I give them an asset finance, they're going to perform as well? So that's something it's a good question. It's worth considering. Yeah.
And then when you look at the two scorecards, you can see there's quite a huge difference between who ranks from AA to EE, what we define as the low risk, and who ranks from AA to CC, what we define as the low risk on the two scorecards. So if you're lending on mobile, you'd probably want to use the mobile loan scorecard because it gives you a bigger chunk of the market that you can lend to on that. But if you define your cutoff limits using the generic, you're going to lose so much on a certain percentage that is going to pick up your facilities. Reason being, the ticket sizes, even on mobile, are lower. So that's the difference. Because when we do the scoring, we're also going to check at the principal amounts and the ticket sizes. So when you look at those ticket sizes, you find that you will lose from someone who can afford 5,000 shillings to pay you back, but because you're using the generic, which is also ranking someone who can pay 10 million shillings, doesn't make a lot of sense.
Can you blend the mobile loan information into the total scorecard? Giving mobile a bit of weight, let's say 10%, it will all depend on what data tells you, what weight it can carry. So you get the mobile as a variable and put it into the generic scorecard. Then it will be a fulfilled scorecard, could be.
Yeah, so we could do that. So what we were looking at was, again, some of the variables which were like opening and closing accounts, because when you look at the number of closed accounts, again, there's a weighting on that. There's also a weighting on the number of inquiries done. So what we did on the two scorecards, we tried now to differentiate the two, because we are going to look at the number of inquiries on the generic scorecard. But if you were to look again on the number of inquiries based on now mobile loans, then we get now to not penalize, but you tend to see that some of the points which are going to be assigned on the scorecard or the algorithm that we have, then is going now to weight most of the customers who have mobile loans down. So that's what we have now. That, and again, showing on the two graphs, just to show now the differentiation. If you are to book, if you are using now the scorecards, the two scorecards to be able to try book customers, then you'd book more of the good customers based on the mobile loan scorecard if they're borrowing on mobile, compared to the number of customers you could have booked compared now to the generic scorecard.
Okay. I'm liking this discussion around the scorecard. Yeah? Shall I suggest something? Because we seem to have overshot it. We can continue the discussion over lunch, delve a little bit deeper into it. I think one interesting exercise to do would be to look at, and Vincent, I think you've volunteered for that, is the customers that you said no to based on the generic scorecard. How do they score on MLS, and how have they performed? That'd be an interesting exercise to do, yeah? So thanks for volunteering on that. Appreciate it. Okay, so but kind of just like to bring it together. So I know we've given you very high-level insights, but we wanted to give a teaser of, when we come in and sit with you in your meeting rooms or your boardrooms, starting to delve deeper into these insights, what can we bring to the table? Today we've looked at the market in general, but then the interesting discussions now go into, so if you're looking at mobile, if you're looking at, let's say you tell us, go back, crunch your data, come back to me after 1 week, and we're just looking at specifically at personal loans, let's delve deeper into that, yeah? How are my customers doing with me on personal loans? How are they doing out there? And what can I go for out there, yeah? Without increasing my risk or exposure. Yeah? Those become very interesting discussions. They're broken down to products, strategy in general in terms of where are we going to focus on. And that's really what we'd love to have discussing with you over the next few weeks as we come through to meet with you. But thank you very much for the productive session and also engaging. Yeah.
I just want to just say that it's been a really engaging and interesting session. My one takeaway is that we've got to tell all our children, once we used to tell them to be lawyers and doctors, today we've got to tell them to be data scientists, because that's one place I can see where the jobs are going to grow exponentially. But I'd like to thank TransUnion. I'd like to thank all the officers who came for this session, for a really engaging conversation, and I think you've really opened our minds to this brave new world that we've already entered in, we're in the middle of, and those who tell us we've yet to get into it, I think they don't realize how deeply immersed we are. Can I give you a chance, Billy, to say some closing comments before I give it to Lee to make the final comments?
Thank you.
Trying to think aloud while you have two scorecards, and from a lending perspective, I think all of us probably have some background in lending. it's a bit difficult to have one kind of a lens to look at everybody. The kind of standards you apply to a corporate loan are not the same standards you apply to a micro loan. I think all of us are aware of that. It's not possible to apply one particular kind of standard for everybody. And that's why probably it makes sense to have a different scorecard. A very classic example is microloans versus the rest. Even getting a banker who does microloans to do corporate, it's almost impossible, or the other way around. They really have to change the mindset.
I think one of the things we'd like to really take forward out of this discussion is, because we've done it before, can we look at working with you around your data and your scorecards around customized scorecards? It would become very, very interesting, yeah? So again, thank you very much for coming through. Like I said at TransUnion, this is really what we're all about, yeah? I know Chad said it. When Lee was quoting me, I also told him if it's a bureau, I'm not interested, huh? Yeah, but it's really about, this cool stuff, and as we got talking, it sounded very exciting. There's all these insights that you want to bring to the table, and at the end of the day, yeah, I know we're talking digital, but we all have to agree that majority of the biggest values when it comes to the credit market really sit with the banks, yeah? And it's going to be like that for quite a long while. So we really want to work with you, work with you as partners, and really deliver that value, which I know we also haven't done very well, but trust me, we've reformed. We've invested a lot in our data capabilities. So feel free to reach out to us. Ask our data guys to come through, sit with you. They don't charge per hour. We are happy to come and engage. Kind of just like look at some of these insights that are available, and let us help you build your strategies going forward. But thank you very much for coming.
Thank you, Billy, for those comments. If I can now turn to Lee Naik to make the closing comments. Lee, of course, is the president of TransUnion Africa. And what I really found interesting, amongst lots of other points you're making, and your general philosophy and outlook I thought was really refreshing, was about the fact that you've got visibility on so many different countries, and that you can also help us with what you're seeing happen in other markets, which can apply. In some ways you can be a filter for us, filtering out the noise and telling us, look, this is really working, could be as far away as Colombia, and I think that would be also very useful for a market like ours. Thank you.
Thanks, Ali Khan. I guess in closing, a couple of thoughts worth noting. I believe that Kenya has so much more potential than we've currently realized. I think M-Pesa was kind of how we got here, but there's a lot more we need to do as the key players to deliver on the opportunity potential for Africa. From a risk perspective, we're still starting to figure out how to use data and even things like scorecards. Back home in South Africa, we have dozens of scorecards, and it's an interesting concept, and I've asked Billy and the team to spend time educating all of us on how we use different scorecards. So, for example, we have generic scorecards, we'll have a retail scorecard, we even have customized local scorecards just for one client only. So every client has a different circumstance. And remember earlier we said that we may all have the same data, how we approach our strategies will be different. So we will help, as Ali Khan said, help with the education, what works, what hasn't worked. I'm a massive driver of financial inclusion, and we've got some IP and offerings that are really proven across markets like India, like Colombia, and now in South Africa. Just in the last few months of us launching in South Africa, we have 9 of the key players that are on the credit vision journey to us. So not only do you need to start the journey at the beginning, you may be able to skip ahead and jump forward several steps of learning that we've done as countries around the world. So we are committed to bringing that offering and insight to you. You need to challenge us, you need to ask us and make it happen. One of the final thoughts I'll leave you with is that of all the questions I've heard today, whether it's how do you use life stage triggers or how do you know what's really going on in my point of need, and as Ali Khan has said, these are questions that have come up many times over. So as you hear about questions or read things, ask my team, ask me, reach out directly if you need to, and ask us what have we seen, how have people approached the problem. Let's not be scared to reuse and repurpose and to build on. And as we debated earlier, by collaborating we'll be a lot more successful. So thank you for your time from my side. I really appreciate you giving us an entire day of your time. And we have lunch served. We'll have many more conversations today and in the ongoing days. And hopefully from your perspective, you've started to see that TransUnion is not just a credit bureau. We're a company that believes in information for good, and we want to partner with each one of you to drive outcomes for you, your organizations, and for the citizens of Kenya. Thank you very much, Ali Khan.
Thank you. Thank you all for being such a great audience, and I thought it was really an interesting subject that we covered, and I really appreciate what you were saying and to all the speakers today. So thank you very much. Thanks.